Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Sherman.
Okay, welcome everybody to this week's Sparta Market Outlook podcast. I believe it's episode number 23 today, so quite exciting to get there. And today I am joined by our co-star, I would say the main star of the show, maybe. I don't know what the fans have to say, but Neil, you're always here. So hi, Neil, how are you?
Very well, thank you. Yeah, all good.
We're also joined by June from Singapore. Hi, June. How are you today?
Hello. Very refreshed after Lunar New Year.
Oh, yes, indeed. How was the holiday? Did you go anywhere nice?
Stuck in Singapore. But it was all good here.
All good. Excellent. Well, Happy New Lunar Year. And Phil, how are you today?
Good, thank you. Also refreshed from a week off, so ready to go.
Excellent, excellent. Well, I hope you are refreshed because I think that, as we've been discussing for the last weeks, and I'm pretty sure that we will be discussing for the next 4 years, Trump is the star of the show, almost as, in stardom territory as Neil in this podcast. But no, but and he's obviously running the show right now with his constant announcements, changes, etc. So obviously, we need to start talking about tariffs. So, Neil, can you walk us through what we've learned over the last days or weeks that will have an impact over the coming weeks? Maybe let's start with that.
Okay. And you guys can chip in. I'll start us off, but maybe just the first comment on refreshedness. I don't know about you guys, but it's very tiring being an oil market participant under the Trump administration.
Yeah.
For 4 hours, something happens and you have to start thinking again. But anyway, the last week, what do we have? So Canada, Mexico delayed. We ended up with just China tariffs. Let's very quickly go through that. The US sends about 250 KBD of crude to China. A big majority is WTI. Some of it is Mars. I think we can very quickly say not much impact. Is that fair enough, June? I mean, all this really means is that it's intra-Asia rewiring, right? Is that fair?
Yeah. I mean, it's only like 2% of the total quantity coming from the US on WTI side. And that can easily be absorbed anywhere else. So yeah, very little impact indeed.
Yeah, I was going to ask that. So it's 250,000 barrels a day, but the percentage is 2%. So yeah, not dramatic, essentially. Yeah. Okay.
And it just gets sent elsewhere in Asia, probably. So it's much ado about nothing in the crude market, let's say. And it's just crude. It's no other hydrocarbons. Is that correct, or is it LNG?
Yes. Yeah. It was LNG, coal, and crude oil only.
Yeah. Okay.
Oh, so LNG. So the impact on LNG can be quite significant then. Okay.
Yeah, potentially. Yeah.
We don't cover that much LNG, so let's not get too excited on things that we will not be able to comment about. But that's definitely going to be a big impact on LNG, yeah, for sure.
Yeah. And then the sort of next thing I wanted to discuss, and you guys can chip in. The next thing is Europe, right? So very quickly, what have we learned about the last week that is relevant going forward? My take from the last week was that you could be forgiven for thinking that Trump never really intended to put tariffs on Mexico and Canada in the first place.
Yeah, it's brinksmanship. It's escalate to de-escalate.
And that's something that I think we said multiple times. We don't think is going to happen, but if it does, X, Y, Z. And the tariff threat got resolved with sort of relatively insubstantial concessions being made by the other parties. I think that's fair to say. It looks like a political win for Trump. And one thing I want to talk about as well is just the market action, including on crude around the event, right? Also on flat price. And I just wanted to say, money does talk, right? And it's worth remembering that. And if Trump is going to threaten something that is really bad for global trade, the markets react to that. And
Yeah.
you have to remember, particularly in his first term, he was treating the S&P 500 like his own personal scorecard, right? And
Yeah.
it will be at the back of his mind. So you have to think, okay, in the next round of negotiations, let's say with the EU, is he really going to do something that is going to be very bad for the market type thing? However, he's got the EU in his crosshairs. It's going to be a trickier deal, right? Because he wants more substantial things from us. I say us because we're sitting here in Europe, including more defense spending, including buying more US products. That includes buying more US energy. That's something that he's mentioned in the last
Yeah.
couple of weeks. I would not, I think where I'm going with this is I would not bet the house on this being another easy deal as it turned out to be with Canada and Mexico. Is that fair to say, Phil? I think you kind of see things similar to me.
Yeah, it's going to be interesting to do this kind of thought experiment for what's going to happen because it looks pretty certain that, as you say, the EU's in the crosshairs, and the EU doesn't really have the ability to, we can't just send some troops to a border and promise to stop some drugs flowing and have this kind of at least put on a back burner for a while. It's much more complex than that. And it's not. I mean, there is a NATO meeting coming up, the next kind of NATO summit coming up. So maybe there's a chance to time it around that, and you end up kind of getting these proper 2% concessions or even more on the defense spending. So there are some kind of potential out paths, I would say, but it's certainly not as easy. Yeah.
Well, it's obviously going to involve Russia. And so, as you said, it's this whole NATO situation. It's going to be much more tricky. Um, and yeah, no, I fully agree with you, Neil. This is going to be this is going to take the 4 years. It's going to be the core thing for him over the next 3 to 4 years. Yeah.
You're right to mention Russia because it's also the Arctic, for example, is a hot geopolitical, let's say, commodity, or it's not the wrong word at the
Yeah.
moment, and that's also why Greenland is getting involved in the discussion at the moment. And there's sort of very limited things that Europe can do about that. They don't spend enough on defense, or they want to defend Greenland sovereignty. The US has other ideas, or the Trump administration does, so it makes things very, very difficult. So where are we going with this? The chances are potentially higher that we get some kind of trade spat emerging between the US and the EU. I think that's fair to say. And something that we mentioned in our special pod on Monday, it's worth gaming out a little bit. What happens if you do get sort of Europe ends up putting a tariff on WTI that's much more disruptive for trade and also on the product side of things. Obviously, the US is exporting a lot of diesel, some of which ends up in Europe. There's the ARA to New York Harbor story. It could be far more disruptive for a short period of time.
Oh, definitely. I mean, it's all of these sort of very standard trade flows that are significant. It's not like a 2% flow from US to China on crude. This is like, I wouldn't be able to tell you the exact percentages, but it's maybe 10, 15, 20% of the natural trade flows is, what you're describing right now. So can it be rerouted and all that? Of course, like we've seen with Russia and all that, at the end, the market finds its equilibrium in one way or another. But it will be a massive disruption. And the problem is that, as we've seen with the Canada and Mexico example, is that disruption it's not going to be resolved within the same day, where, you saw suddenly the TAR from gasoline, explode and all that, and then within the same day come off. But maybe this takes longer, because the rumors, the negotiations will be longer and more complicated. But yeah, it's going to have a dramatic impact. And again, it's the famous saying, buy the rumor, sell the fact. But now they're not talking about Europe. They're just saying, hey, we will be talking about Europe at some point. Okay. So everyone is sort of playing catch up with whatever he has in mind. But the moment he starts actually working on this officially, then we're in rumor territory, and then the market will have to price itself in that territory. It's going to be very messy, very, very messy.
And speaking of that, that's a good segue into the next little segment we have, right? Iran. So the story yesterday was there was another Trump tweet, maximum pressure returning on Iran. And that basically saved what was turning out to be a pretty poor day on flat price, actually, yesterday.
Hmm.
And you remember last week I was saying flat price looks like a buy. I was completely wrong there. Every time as soon as I mention anything about flat price, it's obviously going to do something else. But yesterday it rescued it. So very quickly on Iran then, because that's the next thing he's addressing. I would say the base case still needs to be, as we discussed the last couple of pods, very little change can be expected. It's difficult to enforce anything when China is the main or even only buyer. There is the so-called
Oh, India.
Ship Act. India doesn't buy much Iranian.
Oh, you're in? Okay, sorry. Yeah,
Um,
yeah. Mhm.
yeah. Um, there's the Ship Act or the Ship Law, which is stop harboring Iranian petroleum. And what that did in the first time round essentially was funnel Iranian all into one place. And again, it's the problem if you have to get the Chinese to agree to stop buying it. I think that's my take on that. And so that's a buy the rumor, sell the fact type thing. I do think there's a slight chance, as we've said before, it gets caught up with the wider Chinese trade deal phenomenon, let's say, with Trump, right? And he's already started this off. I don't think China has an interest in starting a massive trade war, particularly at the moment, considering its domestic economic
Yeah.
performance and
Yeah.
its reliance on trade. And I think there's a slight chance that this ends up as part of a wider deal in China. That's maybe where I stand right now on the Iranian situation.
No, I agree. And as we've seen with the response from the Chinese officials, it's the general commentary is that it was um, quite shy, to put it in they were not very aggressive on their response. At least that's what most of
Yeah.
the analysts are saying. So indeed, it's a suggestion that they don't want to get into this trade war. But it's surprising because now it's the time where you need to show strength, especially with a guy that only reacts to strength like Trump, So interesting.
Yeah, it's something we'll need to get into maybe in more detail soon. But in terms of end game for Trump and Iran as well, that's something we need to kind of think about in terms of, why now the maximum pressure. We've kind of talked about it a little bit in the past, but maybe we'll need to address that to find out kind of, how long this is going to be going on, or what would be the end game there.
Well, just on that, I mean, just because we have one more minute on it, maybe. Why now? Because he talked about it on the campaign trail, and there was the recent UN Security Watchdog, Nuclear Watchdog report back in December, which basically stated Iran is getting very close to producing enough weapons grade uranium, right? So they're getting closer to acquiring nuclear weapons, and that brings up the level of urgency, I would say. And this is all wrapped up in this kind of topic, right? So it's a thing for the first half of this year rather than the second half, let's say.
Sure, sure.
Should we move on to actual fundamentals or anything to add on the more macro status?
No, let's move on. Let's do some physical oil market stuff.
Fantastic. So, okay, well, June, Neil, let's start with crude. Maybe let's look at the AFS market. Can you guys tell us what's going on there? There's been some activity.
It's going largely the way that we suggested, where MEG premium has been coming down about $1 per barrel in the last 3 sessions of trade. We saw the EFS rally substantially at the beginning, but lost ground this week, partly due to flat price action. On the upside, sorry.
No, it's just to confirm, we're talking about the Middle Eastern spot premium, right? So they are cooling very rapidly, or not rapidly, but each day another 30, 40 cents since the Lunar New Year holidays ended, right? So it is largely as we've anticipated, and that's basically all the angst coming out about the Russian sanctions. Is that fair to say?
Yep, yep. I think the
Plus, you have
impact that the
things
yeah, Russia side, it didn't perpetuate to the initial frenzy at the beginning, where everyone just had to find a replacement barrel. But I think people are now seeing um, uh, vessels being unloaded, cargoes being unloaded. Seems to find its equilibrium already.
yeah. So,
So
so what's still open then? So now that the EFS is, I mean, actually the EFS did rally, but now it's basically back to a week ago levels. What is still open on the crude side in terms of like west to east arb? Can you
Yeah, let's break it
round us
down
up?
to yeah. So let's see light side. The open crudes are CPC, WTI, and 40s. And 40s landing at the premium to Melbourne, but still much closer than over most of 2024. On the heavier grades, 2P, Mars, Bonny and WAF grades are open. Johan Sverdrup is still closed. And we are seeing that European crude is still cheap enough to up to Asia.
Yeah, so that goes into our EFS trade. So we're still kind of saying we think the EFS is, let's say, a buy, or Brent to buy swap is a buy still. Is that fair enough, or can you take us through that?
Yeah, I mean the points that lead us to think that the EFS should widen. Number one, April is where OPEC starts to unwind. 160, 120 KBD-ish also coming back. TA
On
activity is
paper,
also on paper, right?
in theory.
TA activity is peaking in the east in April. We saw BLCC rates rising this week, but that's all on the tariff and the Iran maximum pressure chat. So that may also drop off again. But most importantly here, we are seeing WTI expensive into Northwest Europe. Okay, so why is that a big point that we are reflecting here? The DFLs and the 40 swaps is actually quite weak, likely due to turnarounds in Northwest Europe. On Tuesday and Wednesday, we saw 40s cheaper than WTI VLCCs in Northwest Europe. Really abnormal behavior. This is
Yeah,
partly due
I
to
think we
VLCC rates. Yeah.
I think we've never seen that in our tool before, just to mention. I don't think I've seen 40s landing cheaper in Northwest Europe versus a TI VLCC before. I think that's the first
Mm.
time.
Yeah, so it's partly due to VLCC rates rising globally, still at the moment, and FRAs are still cheaper. Uh, MEH diff is about 50 cents higher than this time last month. Could be the up demand being strong from Asia. And TI Brent is quite volatile at the moment, and even now it's approaching like -$4 per barrel. And since TI can up nicely into Asia, maybe it can't get any cheaper than this level already. Uh, i.e., WTI is being beat up to the level of still expensive Melbourne. So what does this mean? We think we think that it means that North Sea grades can get more expensive. And on top of that, you have stronger refining margins in the West of Suez, uh, kind of headline driven by the distillate cracks. But it does mean that North Sea premier can go up further. Okay, on TI Brent side, we are looking at bills happening in the US and turnarounds ahead. Some bullishness likely ahead for Brent as well. So maybe TI Brent can shoot wider than $4 per barrel for a spell, but that's a low conviction call. So in summary, Brent rises versus Dubai, WTI loses versus Brent, WTI versus Dubai stays about par to keep WTI and Melbourne econs about the same.
okay, thank you for that. And what about heavy crude? Obviously, it's expensive globally now, but what do you guys have to say about that?
Well, these heavy grades include Latam, Johann Sverdrup, Mars, and Vasconia. Johann Sverdrup FOBs are at a 7-month high, Lisa as well. Last time in Q4, we saw this extreme heavy light FOBs corrected itself. So we are expecting that the heavy should be less expensive going for this trade cycle.
Yeah, because we are, correct me if I'm wrong, but we are at this multi-year bottom, no, on the light versus heavy spread, no?
Exactly, yeah. We do this kind of global indicator, which is not strictly, necessarily the best methodology for anything, but just kind of averaging out regionally is light crude strong against heavy. And I like to look at that occasionally because it does sort of reach an extreme and then it tends to drop off. And for whatever reason, it could be that refiners tend to pick up a bit more of the cheaper grades if they're light, let's say, and that kind of corrects itself. And that's the situation we're in again now. So the strength in Middle Eastern spot market for heavy crude seemed to spread out globally, and that's why you have Swerve up at a 7-month high. It's the same with Guyanan grades, and I guess in tendency, it's another reason why we think the EFS rather the Brent market will be bid up still over the next coming weeks.
Okay, so actually, let's go before we wrap up crude. So, what would be your concrete trade ideas then? EFS has some legs, you said. Tell me more.
Yeah, I still think we're going for the EFS trade. I still think there's lots of things going in that direction, not least because you still have, let's say, the Dubai market unusually strong. I mean, it's weakened a bit, but we're still at kind of multi-year high premia for things like Oman, and I still think a lot of the angst has to come out of the market still. And then the other aspect is we're trying to triangulate this now. We've been talking about this, me and June, this morning. How does these things work out? It's still unusual that you have TI expensive in Europe, TI cheap in Asia. And I think the way that you think about this is that Brent needs to be bid up, Dubai starts to cool, TI ends up, let's say, fairly neutral against Dubai over the next week or two. So for me, that actually might mean that you might get unusually weak TI Brent, for example, maybe even blowing past $4 a barrel, or not -4 even. So that's, yeah, the sort of ARB-based thinking about where these paper spreads need to go. And then we've got flat price. Not even going to talk about it. Totally low conviction. No idea. I'm gonna start talking about it now.
I mean, yeah, rule number one, don't trade flat price. Yeah.
Just a last one from me, if I might. You said obviously light heavy crude spreads are very narrow. Is that, I guess, to a certain extent being driven by very tight residue markets? And I mean, it looks as though, residue cracks are still very high, right?
Yeah, which one?
I'm talking about
Or
380. So Singapore.
yeah. No. I mean, I'm saying what drives the other one. I think that's
Right. Yeah, I see. Yeah.
something that we need to maybe have a philosophical conversation about. But obviously, if you have expensive heavy crude, you tend to be bidding up the fuel oil market as well, and vice versa, in terms of the GPW of a heavy crude is improved when fuel oil is strong, right?
Yeah. Yeah.
So obviously the whole kind of residue
Bit of a
market
chicken and
and the
egg thing.
heavier
Yeah.
residue market's tight. Yeah,
Fair
it's a
enough.
good question though. We need to get Hua on.
Yeah.
Yeah, when is Hua starting to talk with us? When are we getting Hua on the call?
He was on a couple of weeks ago.
Jeez.
Don't worry.
Yeah.
He'll come back.
He'll come back. Okay, excellent. So for those who don't know, Hua is our fuel oil expert. So moving on to light ends, because we have a lot of things to discuss here. So East-West widened again, so that's good. I mean, well, good. We don't really have a position on it, of course, but I mean, it's like good because we were calling this. So it just didn't really feel like it was it was very weak, multi-year low week, etc. And now it's sort of picking up again. Maybe let's start with that, Phil, on the gasoline front.
Yeah. So it certainly. I mean, a couple of weeks ago we were talking about how we were kind of perplexed at why a February East-West could go out to somewhere near $3, and the Sing spreads themselves kind of went into contango, and that did rebound very nicely. Sing spreads came back into backwardation. The East-West came back to levels that were more like kind of minus 140. But actually, it seems to have been slightly caught up now in some of the unraveling of the tariff angst pricing movements that happened. That EBOB has been left looking very expensive still, which means that actually, the East-West has gone back out to kind of minus 190, minus 180 territory, which kind of looks a little bit wide again. So we're in a bit of a weird situation globally on gasoline, and all things that I can see are currently pointing to just EBOB has been left out kind of on a limb, and looks far too expensive for this kind of time of year, and is difficult to justify at the moment.
Yeah, because that's the thing. It's that what we were seeing with EBOB is that we went from this, record, well, not record, but I mean, high contango situation with $7 of contango to now, where is it now, the market?
It's in backwardation, yeah. It's
It's in
plus
backwardation.
120, 140. Yeah.
Yeah, in backwardation. And for, maybe the reasons that we described before around people buying Refremit, so making the blend economics negative, etc. So obviously EBOB going up in price. But now the problem is that we're adding now to that the fact that TC2 has ballooned. And therefore, you're now extremely expensive into any kind of destination. So right now, every single short you could possibly imagine is gone, at least in the Atlantic basin. So it's a double whammy, I would say, in that sense.
Yeah, so when we're looking in the platform, and I'm kind of talking clients through kind of how we look at the gasoline market in the platform, there's a few areas that we look at. We look at the RBOB, so the TA ARB. We look at E10 blend, or kind of EBOB blend margins. We look at the Atlantic basin, where whether those destinations are picking up from Houston or from ARA, and every single one of those indicators is now pointing to there is no outlet for components in ARA, right? We're in backwardation, so the storage player is gone. The blend margins are very closed. Even WAF, even the export kind of market into WAF is closed, right? On an MR, Houston is cheaper. On an LR, Singapore is cheaper. So there's just very little justification for this. And I think TC2 is actually something that seems to have been one of the big winners of this, the kind of the slight panic around impending tariffs. Lots of people were looking to put on kind of reverse TAR on distillate, for example, or hoping to make an RBOB work as well. So TC2 got bid up, and I think that now is likely to be one of the correcting factors, at least, coming off quite strongly now.
Okay. What else can you say about gasoline?
Yeah, so it's all kind of along a similar strain. So I'm not going to talk for too long, but essentially, RBOB is the pricing center that seems to have been kind of obviously most impacted or jostled around by the tariffs talks, and is now obviously has come off most strongly, and now you would expect EBOB to follow that. On the Singapore side, just to kind of note that when the spreads came off towards the end of January, and we were saying that was unjustified, we were doing that on the basis of kind of landed component premium into Singapore. Now that the spreads have come back up, it's actually coincided with a few of those landed premia coming off. So Chinese barrels look cheaper into Singapore. West Coast Indian barrels look cheaper into Singapore. The alkylate premiums have come off a little bit. So it looks as though we're in a slightly softer kind of physical position than we were a couple of weeks ago. So that run up that we had in Sing 92 spreads, and we're now back into a kind of solid backwardation, maybe has reached a ceiling on the basis of the physical premium. There's a little bit more component availability, which is probably balanced out actually on the whole of by the fact that we have this wider east-west now, and every destination in the east of Suez, as well as kind of west coast Mexico, for example, and the Pacific basin, they all are pointing to Singapore or the AG now for resupply. So I think we're in a kind of relatively balanced position now for Singapore.
Okay. And on NAFTA, we've seen the ARB into the east shut over the last couple of days. What's driving that, essentially?
Yeah, so it's been slightly a victim of this kind of wider east-west. So the east-west gas widened again, and naphtha kind of followed suit. But actually, it's been the physical premia that have been kind of the biggest movers. So over the last week, European naphtha cash diffs have been skyrocketing, and we've had a kind of inverse movement on the Asian side. It doesn't. It's unlikely, I think, that can be or will be sustained. There's no kind of indication from the fundamentals perspective that petchem margins are poor in Asia. I think, if anything, the kind of consensus of the tariffs now, kind of between the US and China, is that actually that should be probably a net positive for petchem margins in Asia. So I think it looks as though, again, Europe naphtha has been bid up a bit too much. Maybe the reaction in Asia has also been a little bit overdone. We expect the East-West to come in a little bit anyway, to kind of reopen those arbs again. So at the moment, the arbs from the Med to the east are closed. The arbs from the Med into Europe are also not looking great. So it's probably a narrower east-west again, and a little bit of a sell-off in the European naphtha premium.
Okay, so since we have you here, can we move on to middle distillates, and have a quick update there? What's going on?
Sure. I mean, Neil, I think you've been the one that's kind of speaking to James a lot more of it. I've obviously come back into the market after a week off.
Yeah, I can go.
We'll do it together.
No, just a quick comment on what you're saying about gasoline as well, because we're going to talk about the fact that we think there's a bit more conviction on being relatively short ICE gas oil, and you're saying also on EBUB still looks overly strong.
Yep.
And we're saying on the crude side of things that the diffs in the Middle East, in Asia, are likely to come off, while we think that we're kind of bullish crude in the West. It all speaks to a bit of in the same direction on the margins, right? So we noticed that Northwest Europe margins are pretty strong, like really quite good at the moment. And Singapore has been relatively weak. It's starting to recover with the crude premiums coming off. But from the crude side and the product side, it looks like some of the margin pressure is going to head over to Europe and away from Asia. I think that seems to be the picture we're building up, right?
Yeah.
And just on the middle distillate side, then quickly, as I said, we're getting a bit more convinced that there's enough there in ARBs to be a bit more bearish on European gas oil. So definitely what we saw this week was, let's say, Houston MRs are open to Northwest Europe, and there's a few things going on there. The Gulf Coast diff is actually weakening, kind of surprisingly so, I would say, given the runs picture and the fact we've got another 7 million barrel draw on US distillates due this week. We'll get the data later today. But nevertheless, the MRs are open to Northwest Europe, and there's a bunch of other swing barrels that now point to Northwest Europe. So looking at Sikka, so February loaders out of Sikka, those are pointing to the Med, to Northwest Europe, and to New York Harbor over Singapore.
And that's the first time that's happened for quite a while now, right?
Yeah, it seems to happen less often, and that's why last week we were discussing why is it happening less often. Is it to do with, let's say, WAF runs being maybe 500,000 barrels a day? So now that's open, and also March loaders are open to the Med over Singapore. And just to sort of hint at the fact that Asia is looking generally quite a bit weaker at the moment, am I right that Ulsan to LA ARB for gas oil has been open, at least earlier this week?
Yeah.
And that's partly due to the Ulsan premiums coming off by about $1 per barrel since mid-January. So there's a bunch of stuff that is pointing now to either Europe or the Western Hemisphere. And I think that gives us a bit of conviction about being short ICE gas oil over the next couple of weeks. I mean, the thing with trade flow is obviously it takes time for the physical market to actually feel it, right?
Yeah.
And part of the reason that things are open to Europe just now is the fact that actually the physical premia in Europe, in Northeast Europe, have been actually rising the last couple of days. So it takes some time to be felt, but generally in the next couple of weeks, I think it's becoming a safer bet from the ARB's point of view to be a bit more bearish. And then just looking at the weather, a very quick weather update. Supposedly there's another polar vortex lobe due in Canada and Northeast US in mid-February, and Europe is due for warmer weather. So I guess that goes in the same direction. I think given the state of US stocks, given the weather outlook, I'm relatively long, let's say, heating oil and relatively short ice gas oil. Anything to add there, Phil? Do you think that's a fair assessment?
Yeah, I do. I think especially if we add on to that European turnarounds. Again, we're not in a position to quote exact forecasted numbers, but supposed to be a little bit lower seasonally. I think long Hogo is a good place to be.
Okay, well, I think that sums it up. Thank you very much, everyone, and looking forward to catching up next week.
Brilliant.
Sounds good. We'll have a bunch of tweets to analyze by then. So
yeah, just
I was going to say coming back into the office on Monday after a week off. I was going to say it felt like deja vu from the first administration, but it's worse. So far, at least, it's more intense.
It is almost more. Yeah, you almost need to have like a live feed podcast. Where we're constantly commenting based on the latest 5-minute tweets. Yeah.
Oh, let me check Twitter. I'll just go and check now.
Yeah. Have an API directly connected to the pod so that we immediately have a prompter telling us, what's going on. Anyway, guys, thank you so much, and I'll speak to you guys next week.
Thank you.
Thank you.
Bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.